We will go ahead and get started. Again, good afternoon, everyone. Thank you for joining us today. I am Laura LeBanier-Kitson, your CalTRUST CEO. And joining me today, we have Will Goldthwait with State Street Investment Management. State Street Global Advisors has recently rebranded their name to State Street Investment Management. So for those of you who are used to doing webinars with us and seeing our information, you'll hear it a little bit differently now as we go with their new rebrand. So today we are doing one of our post-Fed meeting market updates. As you all know, the Fed meeting was last week, and so Will is on to talk to us about that and what this crazy world is looking like these days. This webinar is being recorded and will be available within the next week on our website. If you do have any questions, please do make this interactive. Use the chat feature. I made sure I had it properly enabled this time in the Q&A box. And please ask questions, give us your commentary, and let this be as useful for you as it can be. So without further ado, I'm going to pass it off to Will. He's going to start by reading some required legalese, and then we'll launch into the discussion.
Yeah, thanks, Laura. Appreciate it. Good to be here. Summer Monday. So yeah, just to read my compliance disclaimer here, I must let you know that the information on this webinar is intended for the confidential use of clients and prospects of CalTRUST. It's not open to the press. Any review, dissemination, distribution, or copying of this webinar is strictly prohibited. Comments made by Laura and I are our opinions and not that of our respective firms, State Street or CalTRUST, and the comments do not constitute investment advice or analytical research and should not be relied upon as such. We are recording this on August 4th at 1 p.m. Pacific time. So that's it. That's out of the way. My goodness, there's a lot to go through. Holy smokes. Starting with the Fed meeting last week, hopefully folks saw the Q&A that I distributed after the fact. And I think I want to just talk about something straight away with regard to the perception of Chair Powell in his press conference. I perceived Chair Powell as, holding the line, being very steady, and sort of repeating what he had been repeating. More good data, waiting, more good data, more good data. Just as a little side note, he's probably furious after Friday's payroll number, because I'm sure his comments would have been significantly different if he had had that data in hand. But in talking to some of my colleagues and in reading some opinions, later on as they started to emerge, I understand from folks that they had a different view of Chair Powell in that press conference. And that they saw, and these are folks that literally, they'd be very good poker players because they can read all sorts of tells, but they saw a very frustrated chair. I think he was frustrated by the dissents. First time they've seen two dissents since 1993. And that's a big deal because the committee does try to create unanimity. They do want to come across as united in their views and their opinions. And let's just take a step back and think about the setup for an FOMC meeting is not happening on the Tuesday and the Wednesday of the meeting. These FOMC meetings are 2-day meetings. The setup is not, the whole meeting is not happening on that Tuesday or Wednesday. This is something that gets set up 2 weeks before. So 2 weeks before that meeting, Chair Powell begins the conversations with the 11 other representatives. So just to do a quick bit of history, and this will come in my monthly commentary, which talks about Fed independence, but the FOMC is composed of 12 voting members. So 2 weeks out, the chair is on the phone, chatting with those other 11 members, he being one, of the 12, and discussing their views, discussing their outlook, talking about how they're thinking. And so ultimately, he's trying to find common ground amongst all 12. Um, and historically, they have. It is very unusual to have a dissent. Sometimes there can be one dissenter, but it's usually unusual circumstance. The market we're in right now, as is evidenced by Friday's payroll number, is a very unusual market. We're at the point where the market is starting to turn. This turn has taken a long time, right? If you think about what the Fed did in starting in the early days, March of 2022, they raised rates 525 basis points in 14 months. That was unprecedented. And now it's taken an unprecedentedly long amount of time to get this economy to truly slow down. Our chief economist has been talking about weakness in the labor market for a while. And she's been indicating that she is seeing that weakness. That's why we were calling for a rate cut back in June. That's why we were hoping the Fed would cut rates in July. And now we think the Fed actually will cut rates in September. So the chair was definitely, we were sensing some frustration, or sorry, myself excluded, others were sensing some frustration with the chair's comments and sort of feeling as though he's being worn down a little bit by the president yelling at him and by the dissents of Bowman and Waller. So with that said, he still tried to, hold the line on saying that they do think inflation will be transitory. He never used that word, but when pressed in a question about the inflation impacts, he did say they were looking through that impact. In other words, their outlook was essentially recognizing that the short-term effects of tariff on prices would be just that, short-term. And we've talked about this before, right? A tariff is not inflationary because what is inflationary, or what is inflation, is prices consistently moving higher over a period of time. What a tariff is a one-time price adjustment. So something that used to cost $1 now costs $1.25. If it was inflationary, what cost $1 would cost $1.25, and then next quarter it would cost $1.50, and then the quarter after that it would cost $1.75. That's inflationary, and that's the experience we had in 2022, 2021, really, and into 2022, is the prices consistently going higher. So that's the thing that the Fed feels confident with. And then the thing that they also said was that they don't see stresses in the labor market. They see the unemployment rate sitting at 4.2. They continue to see job gains, both in the May and the June number. They obviously didn't have the July number yet, but these revisions in the May and the June number are so significant that it takes the 3-month average down to just 35,000 jobs added per month on average. So we went from a very expansionary number for the May jobs number and the June job number to now, practically a contractionary. Those, I think, I can't remember off the top of my head, but I think the revisions had them down to like 14,000 jobs added in May and 17 in June or something. So very, very low.
What was the original again?
The originals, it was revised down by 250,000 jobs.
Wow.
It was a huge revision down. So yeah, that was a very, very big deal. And okay, so that's the Fed and the Fed meeting. So we came away from that thinking that Chair Powell is really going to be on hold. That's how we came out of that meeting. The inflation data that we got, the core PC data that we got on Thursday was kind of like, it was fine. It wasn't, ground moving at all. And then we roll into, 8:30 Eastern time on Friday morning. We get the release, we get the revisions, and the market rallied huge. Fed funds futures, the 10th contract, which is kind of a bellwether that I look at, is indication of where Fed funds will be in 10 months, was 40 basis points lower in yield. 2-year notes, 2-year treasury yields were 30 basis points lower. So the market had a huge move after that payroll number, with the expectation that the Fed was going to be completely rethinking the path of interest rates, and rightly so. And as I mentioned at the top of the call, the chair was probably very frustrated. I won't comment too much about the president and the firing of the head of the BLS. That's very consistent, I think, with the president being, someone that likes excitement, likes chaos. So we'll just leave that alone. I would just say that I was just asked this question this morning, do I think that could impact the data that the BLS puts out? In other words, do I think that the president now could influence? And the answer is no. There is an enormous process inside the Bureau of Labor Statistics, as far as data collection and data release. So this is probably a good time to talk a little bit about how the Bureau of Labor Statistics collects its payroll data. So it literally calls businesses, calls, emails, connects with businesses, and asks them, how many people did you hire? How many people do you have working for you? How many people did you lay off? There's a whole series of questions that the BLS will ask, and they try to cover about 600,000 businesses. So it's a lot of people doing a lot of inquiry, a lot of people at the BLS doing a lot of inquiry and trying to collect a lot of data. Well, you imagine if you're on the first Friday of a month, if you're trying to report what happened the previous month, there's just no way you can have all of your data collected by that first Friday. So non-farm payroll comes out the first Friday of every month, reporting on the previous month. So August 1st, last week, we reported on the month of July. So that means what the BLS typically collects is probably 30 to 50% of the data that will ultimately go into that. And so then what they use is statistical models to plot, saying, okay, if we've collected 30 to 50% of the data, that data looks like this, then we project that the total employment gains or losses will look like this going forward. So they project out. And then ultimately, as the rest of the data comes in, they revise that. And that's what we got. We got major revisions. Now, why would this model be wrong? The model could be wrong for two reasons, really. The first is that when you're in a transition, so when you're going from a expansionary and growth or recessionary and contraction, the data can just be noisy. You could talk to the first 30% of respondents, and their answers could be different than the next third or the next third. And so that's just what happens when you're going through this transition phase. The economic data gets very noisy as you transition, as you sort of roll over or bottom out in any sort of economic climate. So that's what happened. That's where we are now. We're in a period where the economy is transitioning to a slower growth economy. And this is something that the Fed has been trying to do now since it raised rates in 2022. And the reaction of the economy has been very slow. And we've talked about this before. It's very slow for a couple of reasons. The first is the consumer is significantly delevered. Household indebtedness is a fraction of what it once was, particularly if we snap the line in 2008. And then a lot of folks have locked in on very, very low mortgage finance rates. A lot of people have locked up 30-year fixed rate mortgages, 2.5%, 2.75%, 3%, 3.5%. And so they're not feeling the pain of higher rates. And so that's caused a much slower reaction function in the economy. And so that thus the Fed has remained higher for longer. So let's see, where am I now? We talked about that. Oh yeah, transition. So then the second component to it is the birth-death model. It sounds quite dramatic, but it's really not. It's just the number of businesses, not people, but businesses that have opened or closed. And so the Fed uses that to then project, they're only covering 600,000 businesses, and so then they project to the millions of businesses that exist across the country. So with that said, if more companies are closing or more companies are opening, then they have to, that's going to skew the data. And so then they have to adjust that birth death model to project what job gains have had or job losses have had. So it's a very tricky situation as far as this goes. And it's something that requires a little bit of patience as we sort of flush this data out. So I think that's a pretty important thing to keep in mind as this comes. And we've talked a little bit about this, and it's part of market update deck that I do, is the volatility in rates that we've seen over the last 2 years has been really extraordinary as we're moving through this transition, almost 3 years, really. As we move through this transition, the market has always been early to think that the Fed should be cutting rates, cutting rates, cutting rates. And then the Fed has been very slow. The Fed is saying, no, we're going to stay higher for longer, higher for longer. And so there's this push pull, and Friday was definitely a pull on rates lower. So it's been a tricky thing. Okay, so I see, Laura, there's some questions have come in, and I think we covered the second one. Why was the May, June jobs revision so far off? So we talked about that, and I'll put out. You'll get this, Laura. You can distribute it to your clients and prospects, but I just put together sort of how that BLS function works, what data they're collecting, number of businesses, birth death model. I put all that out there. And this is not atypical. This has happened before. And so this is something that we just, we have to deal with.
It's really interesting how they, this way you're discussing how they do these calculations. This is it's a simple question, but I'm very curious. So you said they reach out to about 600,000 businesses.
Mm-hmm.
Always the same 600,000 businesses?
Um, for the most part, yeah.
Okay.
Sorry, I was just checking my notes. Yeah, for the most part, and you get into a rhythm, right? There's obviously some major employers you're
Yeah.
going to always talk to, right? And we all know who those are. Just think of the largest companies in the country, and so you're always going to be talking to those folks. But then as we get into smaller and smaller business, it gets harder and harder, right?
Mhm.
Particularly if we go down to the mom and pops, somebody that employs 10 people, probably not going to get there. But it's important to know if that business is still going or not going. And so that's where things get a little tricky when you get further down into the weeds.
Okay.
Yeah, it's tricky. And our government has done really a remarkable job of data collection. And the Fed does an incredible job of outreach. So when we look across other countries, we have a really robust amount of data. And it's really important that that remains separate from, you know, the politicians. And the reason for that is because when you look at a country like Argentina, Argentina has had some really significant challenges around their economic viability. I mean, they have gone bankrupt, they have gone broke. And when politicians are able to manipulate economic data, that is just a doomsday scenario for the economy because it's not really measuring what's happening in an economy. And even like when we look at China, some of the data that we get from China is perhaps not as um, clean, maybe. Is that the right word? I don't know. Um, as we might hope. So I think that's it's very, very important that we continue to evolve data collection. One of the things that gets brought up a lot is, the BLS would call homes. I mean, years ago, back when I had a landline, I used to get phone calls and they would ask me all sorts of things. How much did you pay for a gallon of milk? How much did you pay for a carton of eggs? Have you bought a new car? That sort of thing. So the BLS used to make phone calls and call homes, and people used to answer their landlines. People either don't have a landline or they don't answer it anymore because of all the spam calls. So then how are they evolving? And the University of Michigan's survey on consumer expectations of inflation uh, came under scrutiny recently, earlier this year, because there was such a dramatic change in the data. And we found out that the data collection was now via online survey, as opposed to the phone surveys that they had done. So there definitely needs to be a scrutiny over how data is collected, and then how that data is reported back, because nothing's perfect. And we know that there's a continuous evolution of processes. I wouldn't even be surprised if Powell talked about that at Jackson Hole. He's talking about demographics and the shifting demographics. Like the exact title of Jackson Hole is, uh, hold on. Oh no, that was in the Q&A. I forget the
Okay.
exact title. Yeah, I can't remember off the top of my head. Um, but it's about demographic shift and that sort of thing. But I would not be at all surprised if Powell inserted something about data collection and the robustness. It's not his area, right? The BLS is not connected to the Fed. But I wouldn't be surprised if the Fed says something to the effect of, we look at a lot of different data sources. ADP has payroll number, private payrolls. There are a lot of sources. So I wouldn't be surprised if that gets brought up. Okay, so I see there's another question that came in over Kugler's resignation.
That's a great question.
Um, yeah, that's definitely a good question. Okay, so let's just look at the Fed and the FOMC, because I think this is a really hot topic. Okay, so the FOMC is made up of 12 voting members. So there's 7 that are part of the Board of Governors. There's one that is the president of the Federal Reserve Bank of New York. That's a permanent appointment. And then there's 4 rotating seats for the presidents of the remaining 11 regional banks. So there's 12 total. The Bank of New York gets a permanent seat, and so there's 4 more. So that's 12 people that are voting on the path of interest rates, and it's a majority vote, right? So it's a if I guess it could be a tie. I don't think it's ever happened, but it could be as close as 7-5, and that would be the policy action. So the fact that this is the first time we've had 2 Fed governors dissent since 1993 is a real testimony to how thoughtful and how robust the discussion is around economic views. Now, if Waller and Bowman can really start to sway some officials, and they're doing that because of political allegiance, then they have to sway 10 other members of the committee. And these are all trained, economists with decades of experience. So that's a lot of people they have to move. Now, with Kuglerization, let's just say Trump appoints and gets confirmed by the Senate someone else that's going to, act at the political whims of the president. You have 9 other people you have to get to come to your side. Now, I think the jobs data on Friday is going to bring a lot of people over to a 25 basis point rate cut. But I guess my point is that it's really hard with that institution to get it to act politically. And it's not the first time this has happened. And in fact, during the Nixon administration, Arthur Burns was the FOMC chair. He was closely aligned with Richard Nixon. And ultimately, Burns was able to influence the Fed during that early 1970s period in order to get Nixon reelected. He wanted to see some growth in the economy. And then a lot of people point at that as being a real problem for inflation for the remaining decade of the 1970s. And then ultimately, it wasn't until Volcker that came in and raised interest rates to 20% that he really killed the economy and stomped out inflation. And then we've been sort of in a manageable path since. But that was an incredibly destructive, both from an economic standpoint and also from a financial asset standpoint. It was a bearish time. And then prior to that, Lyndon B. Johnson with McChesney as the chair in the early 60s when Johnson was trying to get his fight against poverty, the Great Society program. Sorry, I'm just checking my notes. And also the Vietnam War spending, trying to lower interest rates. So that all, my opinion is that it would take a lot for the current president to create influence on this 12 member open market committee. Okay, so then that begs the next question, and that is this concept or this reality, I guess, of fiscal dominance, a point at which there's so much government debt outstanding or there's such a need for lower interest rates to finance certain things that the government wants to spend their money on, that the Fed has to bend to the fiscal authority, in other words, to the president, to Congress. And that's something that we witnessed happen back in World War II. World War II, FDR had massive economic output that he had to pay for to create the war machine that ended up winning World War II. And so he asked the Fed to keep interest rates low so that the country could afford to do that. And so they did. The Fed came in and they created a cap on yields. They essentially capped and said, we will buy treasuries at this yield or anything higher than that yield. So that put a cap on interest rates and it allowed the government to afford. Now, there was a congressional accord in 1951 that then told the Fed, okay, that's over. You now have to go to your mandate of price stability and act independently going forward because the war's over. We need to pay down the debt. Growth is accelerating, and actually the thing that's really hurting the economy now is inflation is running too hot. So the Fed then got its independence again. The fiscal dominance was over. The Fed remained independent and has been more or less independent over these last years, other than those examples I gave you with Nixon and Johnson. So that's a really important thing to keep an eye on because fiscal dominance might come back into play here as we move forward with the amount of debt that we're taking on in this country, U.S. Treasury debt that we're taking on in this country. And with the big, beautiful bill passed and with the debt ceiling raised, we're heading higher in total indebtedness. We could be 40 trillion in a couple of years. And so that means that this could have an impact. And so we have to keep a close eye on that. Nothing right now, but it's just something that we need to keep in the back of our minds. Laura, I'm just realizing that was a very quick half hour, and I know that's what we scheduled. So
I think we can do a few minutes longer if you have a few minutes.
yeah, of course,
Had a
happy to.
couple other questions. So I'm just got two questions that have popped up here. So one, so I pulled it up. This year's theme for Jackson Hole is labor markets in transition, demographics, productivity, and macroeconomic policy. So that is going to be here, less than 3 weeks before we know it.
Yep.
So a couple questions around that. What do we expect? What are we looking for to coming out of that meeting? And then, we have three Fed meetings remaining this year. Are we thinking we might see a cut at each of these remaining three meetings now?
Yeah, it's a great question. So labor market transition, there we go. Yeah, and that was our chief economist, Simona Modica, who has been in on these webinars before, and we'll certainly have her back for the next one. Um, this is what we're talking about. So the news that we were seeing, the headlines we were seeing on earnings calls, just generally in the press, made us very skeptical of the job gains that we were seeing. Um, And in addition, I've had, these are anecdotes, but still, they're conversations. I've chatted with several people in all different types of business, from legal profession, the consulting profession, the financial service profession, all talking about large language models, AI, creating enormous efficiencies in their businesses. So that's something that we're keeping a very close eye on. So are companies firing? No. Are companies hiring? Yes. Are companies hiring as many people as they might otherwise? No. And I think that's what we're seeing in the economy right now. So a company, instead of hiring two people, it's only hiring one. Instead of hiring 10, they're hiring five. And so there's a very cautious approach, and I think that's what we're seeing. Um, Sorry, I think there was a second part to your question, Laura, but now I'm blanking what that was.
So the question was just what are we looking for coming out of Jackson Hole as far as
Yeah,
where they might go? And then for the next three meetings, if we're looking at cuts for all
yeah,
three.
yeah, the next three meetings for sure. So our call had been, I think I said, we were hoping in June, we were hoping in July, and now we're thinking the Fed really does need to cut by 25 basis points in September, 25 in October, and 25 in December, and essentially bring us down to 3.5%, 3.5, um, uh, yeah, 3.5, 3.25, something like that by the end of the year. And then ultimately by the end of next year, we end up down at 3%. And we think that's a place where the Fed will stay. Maybe it's 3.25, but 3%. And the reason we think that that should be 3% and not 2.5, which is what had been thought to be neutral, probably a year, maybe 2 years ago, is just because we think there's inflationary pressures that will be persistent in the economy. Um, and interestingly enough, the ECB took interest rates down to 2%. They've been very aggressive. In fact, their last meeting was the first meeting they paused. And just catching up with our portfolio manager in London this morning, he's saying the ECB curve has actually got a little bit of cheapness in the credit part of the curve. And in other words, it's pricing in a potential rate hike from the ECB. So that's the market. The ECB itself is still pricing in a rate cut, but yields in the marketplace are giving them an opportunity. So 2% for the euro seems to be the floor right now, according to the market. And so we'll see. So we think three cuts this year, and then ultimately more cuts next year that gets us to about 3%. And then the question is, what does the curve look like? I know investors on this call can buy, debt directly. They can buy 2 years, 3 years, 5 years, et cetera. And so we think there's good value in 2 and 3 year notes. We were long those going into Friday's number. We like that trade. And I think the place where we're a little bit hesitant is the back end of the curve. So 10 plus years, 10 years, 20 years, 30 years. And that's because that part of the curve is wobbled a little bit just with the amount of indebtedness that the US is taking on. So we see value in that back end of the curve, but we don't see deep value. And so we want to wait for that deep value before we buy that back end of the curve. So we're focused on the front end of the curve right now.
Great. I think that really leads to that other question that come in is the outlook on long-term yields over the next 6 to 12 months. So
Yeah. So we think the curve will get steeper. And really 5-year, 30-year is where the steepness will come in. Right now, 2 and 3 years is a part of the curve that we like.
Okay. Um, those are some great questions. Let's give it a moment to see if anybody else has any more questions. I know we did go a few minutes over time, but I think it was absolutely worth it. Folks had to jump off. Actually, not many did. So,
Yeah. I'll just add one other thing, Laura, before we see if other questions have come in, and that is we remain cautious on credit. In the liquidity pool, we're very confident in all the names that we're buying in the liquidity pool. These are all giant GSIFI names, globally, systemically important financial institutions. So we don't have any concerns about the names in the liquidity pool. But when we look at the short-term and medium-term fund, we're just being a little bit more cautious there. We have been for quite a while. And I think this move on Friday underscores that. We think if the economy is headed into an economic slowdown, potentially a recession, then it makes sense to be defensive on credit. Right now, just given equity valuations, given credit spreads, we really are priced for perfection. And we don't think there's perfection out there. So we think it makes sense to be cautious on credit in here.
I mean, I do like a little perfection. Okay.
Yeah, exactly.
All right. Well, I don't see anything else popping up in the chat or Q&A. Just a reminder, this will be posted, it's recording on our website. I say by the end of the week, most likely it'll be done in the next 24 hours. So we'll send a note out to everyone when it is up. But thank you, Will, for your time. It's always great to hear from you and speak with you. And thank you, everyone, for spending part of your afternoon with us. We appreciate everyone. If you have any follow-up questions or want to have any deeper discussions, please don't hesitate to reach out to me. My email address is quite simple, Laura, Laura, at caltrust.org. And with that, wish everyone a wonderful day. Have a great day.
Thanks, Laura.
Thanks, Will.
See you
Bye.
later. Bye.